Ladies and gentlemen, welcome to today's webinar. Today's presentation topic is preparation and sale of a healthcare business to private equity. Our presenters today are attorneys Kathryn Jones and Gary Forster. If you'd like a copy of today's presentation, you'll find it in the handout section of the webinar interface. And similarly, if you have a question, you can type it into the question section of the webinar interface. And now let me turn it over to Kathryn and Gary. Go ahead, folks.
Thanks so much for attending. We appreciate it. Today we cover a topic that's become very relevant, at least in the healthcare space and in general. Private equity now is sitting on a tremendous amount of cash and have been very aggressive with purchasing. We've been involved in a number of transactions, mostly from the seller side, and we thought it would be a very relevant webinar to work through a lot of the details of these transactions. A lot of the healthcare transactions are really very similar to the non-healthcare transactions, but we will go through some of the particular licensure and healthcare related law associated with the sale of a healthcare business. We're going to go ahead and turn off the video so you can see the slides and get into the index.
Okay. Hi, everyone. Thanks for joining.
We've got with delay on our feed. There you go.
There we go. Okay. So we, like Gary said, we've handled quite a bit of these healthcare transactions in the past. I'd say 2 or 3 years. We've seen an uptick in them. So the agenda today is on slide 2, and we're going to hit kind of these 7 main areas. There is quite a bit of content here in the slides, so we may skip over a few things, but if there's any questions or any areas that we haven't addressed, please feel free to email us and we can address those questions.
There's also
offline.
a raise your hand icon in on the screen, and you can click that, and Tony will let us know that there's a question, and we'll address the question right away.
Sure. So we'll start with the introduction, and then we'll go into the letter of intent. Due diligence is the third topic, and a big one for the sellers, and that there's a lot of work and effort that the seller has to go through to meet these requirements, particularly with private equity, since they are very, these equity firms are very thorough in their diligence, investigation, and review. Part 4 is the purchase agreement, which is really where the lawyers start getting into the nitty-gritty of the deal and drafting the documents for the transaction. Item 5, closing. These are kind of the mechanical steps to close a deal. We'll discuss certain aspects, particularly to healthcare transactions, but we will also address the general aspects regardless of industry, post-closing issues, and then conclusions in an open discussion. So what is a private equity sale? It's the disposition of a business or a portion of it. It could take 2 main forms, assets versus stock sales. And we'll discuss this a little bit later, but a buyer and seller can treat a stock sale as an asset sale for tax purposes. We'll also, throughout the presentation, highlight specific considerations that are of interest to healthcare sellers.
A lot of the healthcare deals also involve the seller retaining some portion of the business or retaining a portion of the buyer of the business. We'll get into cash versus equity swaps. That's become very, very popular. And also in healthcare, it's very uncommon to have what we call a walkaway transaction. So that people running the business will almost always have to stay 1 to 2 years to continue running the business, make sure that the transition is smooth. That's something just to keep in mind on some of these healthcare deals. It's very hard to just take a check and walk away.
The starting point for most of these deals is a letter of intent. These are typically non-binding, and they memorialize the business terms and certain, key legal terms that will be used in drafting the definitive transaction documents. Here we raise the issue from the healthcare seller's perspective of confidentiality. Oftentimes, our clients will have investment bankers and other professional advisors helping with the transaction in addition to their legal team. And so from a HIPAA privacy perspective, these professionals may need to enter into business associate agreements that that comply with HIPAA regulations. Oftentimes, investment bankers may have confidentiality covenants and documents that they use in all deals, but in healthcare deals, these may not be sufficient. So there has to be at least a review of the existing confidentiality agreements that the
Right.
investment
So
bankers have.
exactly. So if they call it a non-binding letter of intent because the actual purchase terms aren't binding. But what Kathryn's alluding to is that you will have a few sections of these documents that are binding, including the confidentiality. Another side to the confidentiality beyond the HIPAA is that, you may be getting purchased by a competitor, and everyone has trepidations releasing valuable proprietary information to a competitor because now they can assess your situation and compete with you. So sometimes, there's due diligence under the letter of intent on a confidential basis. But sometimes if you're a seller and you're very concerned about a buyer, you may want a really full-blown side confidentiality agreement, or waiting until there's actual a signed purchase document with definitive damages and means to recover against someone who breaches a confidentiality agreement. It's kind of an exposure, honestly, because it's very hard to enforce these confidentiality agreements. But you want to do your best you can, and sometimes the letter of intent is not adequate.
Another area, particularly in healthcare, is access to the business and the personnel. Sellers are usually very sensitive when they bring anybody on site to do reviews.
Yeah.
It can get the staff a little bit nervous. They may not know what's going on. And so the letter of intent, if that is an issue, or if a seller is particularly sensitive to the access, that should be discussed in the LOI. The business terms, on the other hand, are often non-binding and are subject to the review and diligence of the buyer. And so, but it gives a good kind of starting point to start writing things down. So the price and the payment terms, they're usually, generally agreed to, but they'll be fleshed out in further detail as the transaction progresses. In our transactions, we typically see some amount of cash, but a pretty good amount could be tied up either, like Gary said, in equity in the buyer, or there may be a note
Or an
coming
earnout.
back, or an earnout.
Mm-hmm.
Regarding the earnout, like Gary said earlier, it's very rare that the principal, a doctor, whoever is running the business, can just walk away with a check. And so one of the issues that we're going to have to deal with on these transactions is the terms of employment or engagement by the principal post-closing. And so they will help transition the business and also have an active hand in management and running the operations to help ensure that the targets are met if there isn't.
To basically make sure, if you're representing the seller, that the seller is on board with it, that the actual perspective of the seller is such that they're willing to put X amount of hours into the company every week. If they're not, you really have to start from that point, because it really creates a different dynamic not to have somebody there who's been running the business for a number of years before the sale. That being said, once you figure out the terms of employment or service or whatever you're doing by the existing seller / owner, you want to be very careful to ensure that a breach of that employment agreement is a very high threshold. Like, the breach should be totally clear. You don't want a situation where, for instance, the buyer mismanages the business and now is looking to take it out of an earnout or a promissory note that's due to the seller by saying, no, the seller breached their employment agreement, so we're not going to pay them. The clarity of that breach has to be crystal, and it should be very hard to breach it. In other words, if in fact the seller comes to work or is available by phone X number of hours or does X or Y, there's no way that the buyer can come back and say, no, they breached, I'm not paying your purchase price.
Additional terms that could be noted in the LOI are working capital targets. That's how much gas in the tank has to be left in the business by the seller to operate for a certain period of time post-closing, and also holdbacks and escrows. And we'll get into these concepts a little bit later in the presentation. With these healthcare industry sales, there often is a desire to maintain the tax ID number for Medicare and Medicaid and other payment purposes. And so typically we'll see the buyer want to purchase the equity of the business and not just the assets. And so one of the issues that comes up is for tax purposes, the buyer may also want to treat the equity sale as an asset sale. And we'll talk about this a little bit more later as far as mitigation strategies. But when that election is made, there is an additional potentially tax cost to the seller. And so we will discuss mitigation strategies. The point being here is that we want to consider this early in the LOI, and it paves the way for a smoother conversation.
Yeah,
later.
a lot of these sellers have hard assets, you know, medical equipment, etc. If you sell a hard asset, typically you depreciated that asset over a number of years for tax purposes. And then if you sell the asset, you've got to pay the tax that otherwise would have been. You have to pay the depreciation back. Let's put it that way. So if you have an asset worth $100,000 and you've been using it, this X-ray machine or whatever, over the last 10 years, well, you've depreciated that asset down to almost zero. So you've taken a deduction every year on your tax return. And now the tax basis in that asset is almost nothing. If you sell the asset, you've got to give back all of those tax deductions if the part of the purchase price allocated to that asset is, again, $100,000. So you have to be careful with this. Honestly, many times the buyers will just take the stock. They'll take the box, the corporate box that holds all these assets. And if they buy the box, there's no recapture of the depreciation. But sometimes they'll say, well, we want the box because we want the federal ID number, but we don't want all the tax. We want a new tax basis. We want to depreciate all those assets again. And that's what Kathryn's getting into, where you're not only you're selling the box, but you've got to pay all the tax.
So due diligence, once the LOI is signed, there may have been due diligence going on kind of in the background, but it really gets heavy once you have your LOI signed. And this is usually, it's been my experience that this is where the seller will experience some fatigue because they're being propounded lots of questions and
like
asking to produce a lot of documents.
Yeah.
And so in this section, we'll talk about the key areas that buyers will inquire into, and we will highlight those areas which are of particular concern in the healthcare space. Preliminarily, they're going to want to look at the structure of the business that they're buying, figure out if there's any liens or encumbrances or anything that needs to be cleared up prior to closing. The buyers will typically run a quality of earnings analysis to confirm their numbers and the value of the business, and to establish a working capital target.
So the idea is, for instance, if we take you on as a new client and you're looking to sell, before we get into the sale process, you want to basically have a full financial audit done, everything cleaned up that maybe wasn't exactly perfect before. I know everybody's perfect until the CPA does an audit, and then it's not so perfect. And then on the corporate structure side, for a new client especially, we would update everything, get everything issued. We might need a new operating agreement. It's just, these small issues can be very, very helpful in terms of saving time once you get into the sales process, because you're going to have to do it anyway, but now it's going to be under this microscope. There I am, see, with the what do they call that thing? Magnifying glass, looking at your corporate documents. It's better for us to do it than the buyer to do it.
Absolutely. In the healthcare space, review of HR and personnel becomes particularly important. Down there in point 4, we see some issues come up if any providers that are employed by the business have been suspended or disciplined, if there's any restrictions on their ability to participate in Medicare, Medicaid, or any payor programs. These and a number of other questions are going to come up when the buyer does their diligence.
We've even had full private investigations run. It's uncommon, but it has happened the last couple of years. And even something that we had a client was with two partners, and one of the partners had done something crazy like a decade ago, and it actually delayed the transaction. He wasn't found guilty or anything, but it delayed the transaction a couple of weeks because, he hadn't told anyone. They pulled it on this private investigation, and it was a big freak out. So, we want to kind of get all that flushed out up front. If there are any hitches, we should create an explanation and make clear to the buyer that there's no impact on the business.
Right. Regulatory due diligence. So the buyer is going to want to make sure the business itself has proper licenses. There may be, if the transaction is large enough, you may have to seek regulatory approval from the FTC. These are very large transactions, but that is something that could be a gating item to the rest of the deal progressing to get those regulatory approvals squared away. And then again, we mentioned the BAAs for the investment bankers, but the buyer will also want to confirm that any other entities that the target does business with that are required to sign BAAs have entered into those documents for HIPAA compliance. Operational due diligence. These are the kind of the contracts that go to the day-to-day business of the target. In the healthcare space, these are usually the payor contracts, I think, are the biggest issues with your private insurance companies. Sometimes these payor contracts require the seller to either notify the insurance carrier within a certain number of days prior to closing, or even get their prior consent. It's been my experience that this can be a gating item, and that these insurance companies may be a little slow to respond if they ever do. And so if it's a condition to closing that you have the necessary consents, you want to start the process early. Given that the seller can't always control how timely the insurance company is in getting back to them, what we would want to see is not an absolute requirement, but a best efforts or a commercially reasonable effort standard. For instance, if your seller, your client is trying to get consents or notifications out and they're just not getting responses back from the healthcare company, the contract could say all they have to do is exercise their commercially reasonable or best efforts, or diligent efforts, and that would be sufficient to meet the condition prior to closing.
Typically, this is going on while the regulatory approval is going on. So if you have a change in control of any significant healthcare business, typically you'd have to get state approval. Well, this is the flip side of that. This is the private insurance, if it's an insurance-based healthcare business, approval beforehand. Whereas with this one, sometimes it's basically apathy by the insurance provider. Whereas with the state regulatory, governing board, typically you won't close without that. With the insurance side, you'll close. You try to limit exposure. A lot of times, if exposure can't be limited, it'll just become an indemnity item. Whereas if something goes wrong and the seller caused it, then the seller would have to pay the cost of making it right. Whereas with the state stuff, which we'll get into in a second here, almost always the buyer's going to want a really clear approval from the regulatory authority.
And with the healthcare, the private insurance, not all payors are equal. I mean, you may have a payor who you're getting a lot of your reimbursements from. That may be more important for the buyer. So they may be willing to move on the ones that aren't quite that big of a revenue source. And also, just to point out number 3 on the slide, indirect changes of ownership could trigger the notice and consent requirements depending on how the change in control provisions are drafted in the payor contract, and each one could be different. So we want to identify that early on to see what we'd have to do under the terms of the individual contract with the insurance provider. So once due diligence is done or close to done, I think due diligence sometimes goes on until the day of closing, but we try to get it pretty much wrapped up timely. The definitive purchase agreement is the next step. Again, this is where the lawyers start getting diving deep into the deal terms and putting them down on paper. And so, elements most importantly to the seller or the purchase price and the payment terms. And again, the clarity is really important, especially when the seller is taking back equity in the buyer. Our recommendation would be to ask for the governing documents of the buyer entity early. They're doing diligence on the seller, and I think it's fair for the seller to do some diligence on the buyer. And although those governing documents may not be negotiable, it at least gives, you want the seller, your client, to be aware of what they're taking back if it's not, cash.
Sure. And this is really where a lot of the discussions come in on the substantive side, the business side. The seller will have options in terms of, okay, maybe they have 5 potential buyers. Some sellers really just want cash. They don't want to deal with the buyer's equity. They don't want to put any more of their capital at risk. But some sellers are more flexible in investing in the buyer. Sometimes that's a great move. Obviously, if the value of the buyer goes up, it's a great move. But sometimes I say it's a great move because sometimes the cash is kind of almost the same, or there's a small cash decrease for kind of a nice equity position in what may be a very valuable buyer. So that's the business side of it. And then what Kathryn is saying, we often shock some of the buyers by requesting some of the governing documents associated with the buyer or the buyer's subsidiary. Sometimes it's a large private equity fund, and they have a number of different areas of healthcare, and their radiology subsidiary is buying our client. And we may be taking, not in the radiology subsidiary, but we may be taking back equity from the parent company. And so we'll ask, do you have an operating agreement for the parent company? Because we really need to see what the restrictions on equity are. And they'll be shocked.
Or we'll ask for financials.
But sometimes they will have never been asked by seller's counsel for any of the documents associated with this, $5 million in equity.
And you can be tying up 15 to 20% of the deal value in rollover equity. We'll talk about this a little bit later, but there is often an interplay between, there could be a buyout triggered when the client leaves. So if they're no longer employed by the buyer, that could trigger a buyout of their equity in the parent or the rollover entity that they're getting.
So you have to be, did they get hit with a discount? Is there a penalty for leaving? What are the terms when this seller actually is no longer employed and they're kind of pushed out of the equity position? Are they penalized?
Right. Part of the the deal price could be in an earnout, and so this is cash that's paid based on post-closing performance of the company or the target. And when we're drafting the documents, you like to see a lot of clarity, and to the extent we can make it somewhat objective, what targets have to be met to meet these payouts in the future. Some of the things that we consider when drafting earnout provisions are the earnout period, the payments, the mechanics of measuring the target's performance. Is it an increase in EBITDA or another metric? And also resolving disputes if there's disagreement as to whether the earnout was met.
Well, sometimes they'll if they're part of a group now, they'll be allocated part of the group's cost,
Overhead, right?
you know, and maybe that really should be taken out of the calculation on the earnout because they really weren't allocated that before. There's a lot of little details that come into play on these earnouts. And if you can get an earnout, that's great. You just probably don't want to give up a whole lot of cash for it.
So here we're going to discuss some mitigation strategies if the buyer does want to make that election to treat the sale as an asset sale for tax purposes. At this point, if there's an ask like that, we ask the CPA on the seller side to run some numbers to see what the relative tax costs are to making the election versus just having it treated as an equity sale for tax purposes. If there's a big disparity, we like to ask the buyer to gross the seller up to make it tax neutral. So there will be a payment of additional cash or some form of consideration to compensate the seller for that additional tax cost. After all, the buyer is getting a benefit and being able to depreciate.
Yeah, well, sometimes the depreciation recovery is so good for the buyer that they'll give up some of that advantage back in terms of the tax cost. Sometimes the tax benefit is higher than the tax cost to the seller, and they can negotiate that down.
Right. And the last deal we did, I mean, for example, you know, our client was able to recoup several, like tens of thousands of dollars, I think, in the additional tax costs because we were able to pinpoint that issue early, mention it in the LOI before the details are really fleshed out, and then later in the deal document, you get it nailed down as far as the number and the methodology for calculating that gross up payment. An additional protective measure is indemnification. If the buyer is not willing to gross the seller up, or they just don't have enough information to know what that amount would be, we would have a contractual obligation on the back end that once that amount is calculated by the accountants post-closing, the buyer will indemnify the seller in the event of any increased tax burden.
Yeah, these post-closing issues you have to be very careful with, just as an FYI. It's usually done through a designated CPA, which usually works out fine. Otherwise, it's one of these, we do ours, you do your calculation, then we compare and start screaming at each other. Those are more problematic, and then it would end up going to the one CPA anyway. I'd suggest, unless it's a very large number, that you just choose a CPA who both parties have some confidence in, and let them make the calculation.
Another element of the purchase agreement that we like to address with some detail is the working capital targets and true ups. And so at closing, you have an estimated working capital amount, and then you do a post-close true up or an adjustment. And again, you know, we see sometimes there could be a dispute as to how you get to that number. And then our documents will actually identify the CPA and whoever's going to take on that responsibility of resolving disputes. And we can also, the parties can also negotiate who's responsible for paying the costs of an audit or some kind of.
This is going to take on a life of its own over the last 4 or 5 years. This working capital. This is basically we need you to keep X amount of cash in the company when we buy it, so that we don't run out of cash. And it's kind of become this humongous issue. It never was previously, but basically, if you come to a conclusion early, we're going to keep this much in the company. We're going to calculate. You know, we're going to confirm that within a month later. Usually it's a non-issue, but I would tell you, if you're going to go into one of these transactions, you know, put 2 days aside just to figure out like this working capital adjustments. It's become totally ridiculous.
And then the purchase price allocation, we like to agree to these prior to closing if at all possible. If not, then, you know, we recommend that you build in some kind of mechanism into the documents so you can review and come to an agreement on the purchase price allocation after close.
Yeah, and we may want to spend a second on that.
Okay.
So if we do an asset sale, or we have a stock sale that's treated as an asset sale for tax purposes, the IRS says that you have to allocate, if you get a 100 million, you have to allocate that 100 million among the assets. So the seller always wants to allocate the value, the purchase price, to assets that don't have recapture of depreciation because they don't want to pay the tax on the recapture. And then the buyer always wants, basically always wants to allocate the purchase price to things that have recapture, because those are the assets that they can then depreciate after the sale. So that's your allocation issue.
Seller reps and warranties. This is, from the seller's perspective, probably the most exposure creating aspect of the purchase agreement, and that this is kind of the seller's clean bill of health, so to speak, about the business. That being said, if there are things that are, not quite super clean, you're going to want to have to disclose those in writing in the disclosure schedule, and we'll get into the mechanics of that a little bit later. The reps and warranties can be kind of lumped into two basic categories: fundamental and then non-fundamental. Fundamental reps are those that go to the ability to actually enter the transaction, complete it, and everyone perform their obligations. And so these are things like the buyer and seller legally exist. They have legal authority to consummate the transaction, how the seller is capitalized. These are all fundamental reps that are part of pretty much every transaction. Also in healthcare, that the business has all the required regulatory consents and licensures, and also no brokers down there. That we see that pretty much invariably in that each party is repping to the other, that other than investment bankers listed on Schedule A, B, and C, no one else is entitled to receive any payment on account of the sale. Non-fundamental is pretty much everything else, your financials and other operational aspects of the business, contracts, etc.
Clients.
Disclosure schedules, and so what we see here is, again, like due diligence, this is another painstaking part of the deal process for sellers, and that if there are any reps and warranties that are not absolutely true as written, and usually the buyer takes the first whack at preparing the document because they're going to want very robust seller reps and warranties. If you can't negotiate the rep and warranty to hedge for materiality and knowledge, and we'll get into that later, you're going to want to disclose any kind of anomalies or issues that would make the rep untrue. And so here, the healthcare consideration, here's an example. A common rep in the healthcare space is the licenses held by the providers are in good standing and there's no restrictions on the ability to practice or collect. If you do have somebody who may be on a restriction or they're on probation or whatnot, that will need to be disclosed in the disclosure schedules. And it can be very specific, as like the exact name of the person, which regulatory board is overseeing that person, and what the status is of any kind of investigation or disciplinary procedures.
So on this stuff, there's two things. One is the reason you disclose is because you don't want to breach the representation. So in a number, especially healthcare, a lot of SEC deals, a lot of, and we do a lot of manufacturing deals. You may be operating in such a way that you're potentially in breach of some regulatory net, and it's unclear, right? So typically what you would do is put that on the disclosure schedule, except as provided in the schedule. I'm in compliance with all regulatory, all regulations and laws applicable to my operation of the business, because you may have a gray area and you don't want to be in breach of that representation, or arguably in breach of that representation. And so you're not. The other side of it, the flip side of it, which is often missed in these transactions, is that you want to, if you're the seller, that you want that to be, we had a really funny thing actually happen with this once, but anyway, you want that to be it. In other words, if you disclose it and they know it, if something happens associated with it, you're not liable as a seller. You told them. They assume the liability. Whereas, if we represent a buyer, we say that, that's great that you've disclosed. We appreciate it. You're not in breach of the rep, but if that issue comes up and it costs us money, you've got to pay us back. So we've had all kinds of wild outcomes on this from both I just remember that we were representing the seller, and we won the issue. In other words, if we disclosed it, then they had no claim, and they didn't even argue it. It was shocking. It was a very large law firm, which is common, because you have all kinds of different levels of experience in these firms, and it pretty much relinquished the client from any liability associated.
At that point, we're like, let's go.
Okay, let's go. Who's got a pen?
Let's close it.
Yeah, I mean, it was, and it worked out. It worked out great.
And those are hard to get. I mean, concessions like that, I think, are hard to get. And so, kind of another strategy is to hedge with materiality and knowledge qualifiers. And so, for example, rather than giving an absolute representation and warranty, you're only repping and warranting as to the knowledge of the seller.
Mhm.
Knowledge could be defined narrowly, actual knowledge of, Mrs. A, or you could expand that to an officer position in the company. As a seller, we want to keep it as narrowly defined as possible, limited to actual knowledge. The buyer, on the other hand, if they're willing to give a knowledge qualifier, they will likely ask that it be include both actual knowledge and constructive knowledge, meaning something that the seller may not have actually known, but they had a duty to find out, and they should have known.
Yeah.
And so there's some space there to negotiate what exactly knowledge means.
But it's a risk shift. It's a risk shift. So if you didn't know, then the buyer takes, because the buyer has to prove that the seller knew that there was a problem.
Mm-hmm.
So it's a significant risk shift. It will depend upon the negotiation positions of the parties. But if you can get it in as a seller, you definitely want to try,
Mm-hmm.
because it will move a lot of exposure away from you.
And then materiality is also another aspect of qualifying the rep. I've often asked, well, what's material? And we don't have a good answer for that. A lot of it depends on the industry, the business.
Mm-hmm.
Nobody can actually. Buyers are very, at least it's been my experience, reluctant to assign a number to something that's material. But we like to write it in anyway, just because it gives a little wiggle room. It's not an absolute rep warranty anymore. You just have to be material compliant.
If it's not material, then we didn't breach. If it's a small breach, it doesn't count.
Right. The buyer will make reps and warranties. Most of these are just the fundamental ones about legal existence and the ability to execute and perform the agreement. Buyers are usually a little hesitant to make any reps and warranties. We like to include some language in there that the buyer has done its own due diligence, they've done their independent investigation, kind of is, okay, we've disclosed what we need to disclose, and it's your decision now whether or not.
Yeah, sometimes the financials, we don't know, we don't do financial work, but sometimes the financials may have a note in them or some kind of question, and really the buyer needs to investigate what that note means in the audit, or what happened in this lawsuit 6 years ago or whatever. And a lot of that has to do with moving the buyer to take on their own at least financial due diligence.
Pre-closing transactions in the purchase agreement, you can structure it either as a simultaneous sign and close, where you sign and close all basically at the same time, or there could be a sign, the parties bind themselves to the transaction, and then some period of time passes, and then there's a closing. In the healthcare space, is typically the latter, where it's a sign and a delayed closing, because during that interim period, that's when you're getting third-party consents and kind of buttoning up things to close the deal. And so during this period of time, if the seller's not leaving a lot of cash in the business, that's when you would want to take it out and work out, what has to be done prior to close as far as anything that's not being retained in the business. Typically, the seller will have certain obligations. This is seller pre-closing covenants to maintain the status quo of the business during the interim period. For instance, the seller may not be permitted to make dividends or distributions or hire or fire or bring on new people without the consent of the buyer during the interim period. And the concern is just making sure the business remains intact between sign and close. Conditions to closing, these are the things that have to be met prior to the parties being legally obligated to close. We like to keep these limited from the seller's perspective because once the seller is bound to sell, we don't want the buyer to be able to find a reason to come out of the transaction. Usually during the interim period, that's when you start notifying people, regulatory bodies, and also patients if it's a healthcare business.
Yeah, it's really a seller. It's good for the seller to sign, and it's like a house. You sign, then you close later. But when you have a signed document, I like it better with respect to the seller. This seminar is about the seller because you really now have a contract to close, and in order for the buyer to walk away, they really have to have the right within the contract to get out of it. Obviously, they're going to require certain rights to get out. But it's more protective in many ways. Just the whole posturing of the transaction is different when you just have due diligence under a letter of intent and then just close. Because at any moment at that point, the buyer can walk away.
And what we don't want to see is a condition of closing that says something like the buyer is satisfied with due diligence. We want to have some kind of limit. Okay, maybe 30 days out, you're done.
That's right.
You don't want them to take it all the way, to the finish line and not actually.
If they don't raise the issue, it's everything that has been approved by 30 days from the date of signing or whatever the time is.
And ideally, you'd have a statement in the contract that says, as of signing, they're satisfied with due diligence. The buyer may not be comfortable making that, into the contract, but we'd like to see it from the seller's perspective. All right, how do we get on time? Indemnification, again, this ties in with the reps and warranties, and then if there's a breach of a rep or warranty, then the buyer is going to want to come back to the seller and be compensated for that or to be made whole. And so here we list kind of the different problems that could come up that could trigger an indemnity obligation. There's ways to limit the seller's liability for indemnification claims. One is to put a cap. So, you could put a monetary limit on the seller's monetary exposure for indemnifying the buyer. You could also employ baskets, which are like deductibles, in that, the seller's not going to be liable for minor claims. And we don't want to be annoyed with, small claims here and there. So up until claims aggregate to a certain point, the seller has no liability. The buyer would have to absorb that. And then once you get to that certain point, the indemnification can kick in either from that threshold or it could go back to $1. And indemnity, this is where the distinction between fundamental and non-fundamental reps starts to come into play, is that buyers typically don't want any caps or baskets or limitations on fundamental representations and warranties. They may be willing to, let the non-fundamental ones go or let them expire after, 12 months or a short period of time after closing. But on the fundamental ones, they're going to want that in place for a long time. Rep and warranty insurance, this is something that's kind of been a new, in the last year or so. We've seen investment bankers kind of bring this up.
It's interesting, but it's limited.
And rep and warranty insurance is you find a carrier to write a policy that basically will insure the rep and warranties. So if there is a breach, the policy will pay the indemnity. It's been our experience that for smaller to medium healthcare deals, it's kind of cost prohibitive and it could take a lot of time to underwrite.
If the deal's a little larger, sometimes it's worth getting involved with this. A lot of times because the buyer is very interested in it. In other words, a lot of times the buyer will actually pay all or part of the cost to underwrite the policy because they really don't want to have to start suing the seller. I mean, after a sale takes place, in general, we've for years, sometimes we've had these clients for years, sometimes they're new clients, but we also have a robust asset protection group at our law firm. And it's very, very hard to reach assets of a selling buyer. And honestly, by the buyer really doesn't want to get into a big collection action. And that's, in my opinion, from what I've seen in a lot of this insurance, is that's why this insurance exists. The big hedge fund really wants a pot of money there just in case there's a clear breach. The insurer steps in, pays out the cost, and everyone kind of walks away. The idea is very good. It's just on the small to medium sized transactions, it's very hard to get the thing underwritten, and then the cost can be so prohibitive that it kind of skews the transaction. With a large transaction, though, it's definitely an option.
We've seen it where, you know, if a target's particularly attractive and you have multiple buyers, that may be a way for a buyer to kind of distinguish themselves from other buyers, and that they're willing to kind of sweeten the deal. And then also from a negotiating standpoint, if you are able to get rep and warranty insurance, you may be able to negotiate down the amounts that are held back in an escrow or a holdback from the deal consideration. That just, it's more money up front for the seller if you have that insurance in place. Alrighty, indemnity, again, we talked about limiting monetarily time. You can also put an expiration date on these reps and warranties. So if something doesn't come up or isn't noticed within a certain period of time following closing, that's it. The seller is not liable for those claims. And also, you just want to make sure that if there is insurance or other proceeds available to cover the claim, that the contract, you know, provides that the seller is not going to have to. There's going to be an offset. There's going to be an offset against third party.
And this exclusive remedy comes up all the time. People forget to add, with respect to representing a seller, that the indemnity is the exclusive remedy. Because remember, if there's a breach or you cause someone damage, they can sue you outside the indemnity language of the document unless everyone agrees that that's it. The indemnity is all you get.
We talked about this earlier. This is sandbagging. That's the concept. Like Gary said earlier, if once it's disclosed, it's out. And so we want to see this in the indemnity provisions as well. Like the buyer can't bring an indemnification claim based on a breach of rep or warranty when the buyer knew about the non-conformance. Okay. I'm going to skip ahead a little bit. If you have any questions on this,
if you have any questions, just write them in.
We talked about termination. I do want to talk about the post-closing involvement of the seller and kind of how we want to be careful in drafting employment agreements and consulting agreements. When somebody leaves, when the seller leaves, you want the documents to be clear as to what the rights are under the rollover equity. And so if they have an employment agreement, for example, and there's for cause and not for cause terminations, you want to make sure that ties in to the buyout provisions of the governing entities or the governing documents of the rollover entity. You want to limit the ability of the buyer to terminate for cause, just because you don't want them to be able to create a situation where they can force a buyout under the equity.
And clearly, like if there's a timing issue, like if someone's going to stay for 3 years, maybe after 6 months, you just eliminate, you carve out any relationship between the sale and that employment agreement, because that's kind of a means by someone allowing a buyer to reverse a transaction. All of that, all of that kind of goes hand in hand with, okay, who's going to have to stay? Usually we like to limit it to just 1 or 2 people that, totally instrumental in the operation of the company. And then the rest, look, we're going to try to get everybody else on to stay on board with you. There'll be a representation with respect to, we got these people to stay on board. And you want to limit that as well. I think we did our best. We made our best efforts to get these people to stay on board. But if someone doesn't stay on board, it doesn't blow the transaction.
Absolutely.
Yep. So we hope that was helpful. There's a lot of detail associated with this type of transaction. They've become very, very popular in light of the consolidation of the industry. If you have any questions, our phone and email is on the last. All right. Have a good day.
Take care.